Everyone, Couch Investor back to another video for today, and happy Thanksgiving to all of you celebrating. Hope you're all having a wonderful time with your friends and family, not spending too much money on things you don't actually need. I mean, who are we kidding here? Even I'm guilty of buying stuff I don't need because there is a nice promotion. Now, in this video, I want to talk about 3 dividend-paying companies that I do think can be good companies to hold in your portfolio and actually hold forever, because I do think that these companies will continue to pay a nice dividend to shareholders while also buying back their own shares. Now, I'm not going to talk about Coca-Cola. Just saying that does not mean that Coca-Cola is not a great company. I just think that the alternative, which is one of the first stocks we're going to talk about, which is PepsiCo, could give you a more diversified option. Because Coca-Cola, if you look at their brand portfolio globally, you're getting exposed to, of course, one of the strongest brands on the planet. But if you're looking at this, you're seeing beverages. With PepsiCo, you actually get beverages and snacks and some other stuff here as well. So, in my opinion, a better option. Of course, I'll show you extra reasons why I would go with PepsiCo right now. So if we're looking at PepsiCo, the stock, the valuation metrics, so PE next 12 months, EV to EBITDA, price to sales, price to free cash from the last 12 months compared to its 5-year mean, you can see that currently it is cheaper. It is actually cheaper. Besides price to free cash flow in the last 12 months, that's actually spot on, pretty close to its 5-year mean. But currently you have a forward PE of 21.2 times compared to its 5-year mean of 23.7 times, EV to EBITDA of 15.1 times, price to sales 2.5 times compared to 2.7 times. This means you have a market cap here of $235.42 billion. One share will cost you $169.2 with a dividend yield currently sitting just below 3%. I believe Coca-Cola is just above 3%. Now, if we compare both stocks, Coca-Cola and PepsiCo, forward PE is actually exactly the same right now, 21.2 times, but the 5-year mean for Coca-Cola is a bit higher than PepsiCo. If we look at EV to EBITDA, there Coca-Cola is a bit more expensive. The same can be said for price to sales, but price to free cash flow, Coca-Cola is now below Pepsi. And of course, like I said, just because you're buying a dividend-paying company doesn't mean you're not getting some other advantages. For example, here in this case, you can see that shares outstanding in the last 10 years for PepsiCo have been coming down quite nicely. Free cash flow per share, this is on fiscal year, so we're still missing here a quarter for 2023. But free cash flow is not an issue. If you look at the EPS estimates for the 5-year growth rate, we're sitting at right now 8.45%. Now, if we go and look at the recent results, so for the third quarter, we have here net revenue growth 6.7%. But if we look at the organic core one, so that revenue growth increased 8.8% year over year. Core constant currency EPS change increased 16% year over year. Then for fiscal year 2023, the company now expects to deliver 13% core constant currency EPS growth, previously 12%. And consistent with the previous guidance, the company continues to expect 10% organic revenue growth. Then looking at the graph here, as with most stocks in the last couple of weeks, we have seen some uptrend. Actually back here mid-October at around $160. It was a bit oversold on the weekly. Currently we're a bit closer, like I said, to the $170 mark, which was previously a local support here back in January. Maybe this can be a resistance right now, will remain to be seen. Of course, the market is closed today and Friday, so we'll see what happens on Monday starting next week. Now, I'd like to repeat myself, just because I'm covering PepsiCo right now doesn't mean that if you own Coca-Cola, you have to sell that position and buy PepsiCo. I'm pretty sure a lot of you actually own both of them in your portfolio because both companies are great companies to have in a dividend portfolio. Both buy back shares, both pay a dividend, both increase dividend payouts yearly for a long time. So definitely one of those core holdings in a dividend portfolio. Now, before going into the next one, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, stock number 2 is another one of those huge companies in the United States, one of those companies that keep on increasing their dividend payouts and also buying back more shares, and that's the Home Depot. Now, the Home Depot right now has a market cap of $307.7 billion, forward PE 20.4 times, a dividend yield of 2.7%, and the cost per share is now at $309.2. And here, as you can see in the last 10 years, well, shares outstanding have decreased quite nicely. Free cash flow per share has increased. Of course, we have peaked here in 2021. Then with regards to the growth rates for the next 5 years, we're now at 8.84%. Now here, if we look at PE, EV to EBITDA, price to sales, price to free cash flow, compared to its 5-year means, we are basically the same. We are now back at the 5-year mean or pretty close to that. So some of you might say, maybe I'll wait for a little pullback, which by the way we had in the last couple of weeks. The stock was under $300. We also had the earnings report, which I'm going to touch on in a bit. So you might say, maybe a bit too expensive for me right now, especially in the current market environment. Maybe we're going into a recession, so these types of companies might get hurt. I totally agree, but again, I'm talking about companies to add in your dividend portfolio that you will hold for a long time. Basically call this a coffee can portfolio, meaning you buy, you hold, you don't touch it for a decade or more. Now in the latest earnings report, they reported sales of $37.7 billion. That's a decrease of 3% the same quarter last year. Comparable sales in that quarter decreased 3.1%, and comparable sales in the US decreased 3.5%. As for net earnings for the third quarter, those were $3.8 billion or $3.81 per diluted share, compared to net earnings of $4.3 billion or $4.24 per diluted share. Now, with regards to guidance, so they narrowed the previous fiscal year guidance, which, by the way, they meet expectations. They also had a double beat for that quarter. So sales and comparable sales to decline between 3 and 4% compared to fiscal 2022. The CEO and chairperson did say that similar to the second quarter, we saw continued customer engagement with smaller projects and experienced pressure in certain big ticket discretionary categories. Talking about the ticket, if we scroll down here, we can see that the average ticket actually decreased just 0.3% year over year. As for sales per retail square foot, that decreased 3.7%. Now, overall, like I said, this is a company just like with one of their competitors, Lowe. I know a lot of you own one of the two companies. Both are great options. Just in this case, I wanted to choose the Home Depot. Now, looking at the graph here, like I said before, in the last couple of weeks, we have seen a lot of stocks go up. So yes, the stock was $278 for those that picked up or added to your position. That was pretty much a good buy because it was the lowest it has been since, well, October 2022. We're now over the 20, the 50, and the 200-day moving average, with the RSI still pretty neutral here. And for the sake of this video, I will show you a comparison between Lowe's company and the Home Depot. So as you can see, by the way, the Lowe company is paying a 2.2% dividend compared to a 2.7% of the Home Depot. Not such a big difference, but just so you know. And yes, if we look at the valuations, Lowe is cheaper than the Home Depot. PE, EV to EBITDA, price to sales, just price to free cash flow, Lowe is a bit higher. Then company number 3 is maybe a controversial one because of the industry it is operating in, but in my opinion, with the dividend yield that it's currently offering, I mean, it might be a no-brainer for many. And that's Altria Group. Dividend yield currently at 9.52%, forward PE 8.2 times, market cap $72.85 billion. Now, if we look at the valuations compared to its mean, it's now lower than its 5-year mean, 8.2 times, EV to EBITDA 7.8 times, price to sales 3.5 times, and then price to free cash flow 8.6 times compared to 10.8. And here as well, you can basically see the company is paying a nice dividend and also buying back shares. Free cash flow per share has increased throughout the years. Here, EPS growth is a bit lower than the other companies we've covered in this video, 3.56%. But I mean, if you look at the annualized growth here for the dividend, in the last 5 years, 5.85%, in the last 10 years, 7.76%. Pretty nice if you ask me. Now, of course, there is a reason why this stock and many other tobacco stocks have come down recently, because of the switch in sentiment towards smoking, towards smokers, whether it's regulations or whether it's just people being more healthy, so they are just not smoking anymore. But there is that vape generation that is growing and growing. Now, despite all that, yes, the company did miss on the expectations, but despite revenue slowing down a bit, profitability-wise is actually getting a bit better. And I mean, even with all of that, right, even if the stock does not move one bit, you're still getting paid quite a nice amount with the dividend. So with the dividend payout, you can just reinvest. And over the years, because of you reinvested all those dividend dollars, your shares just increase, which means that the dividend payout becomes bigger and bigger. And over time, your cost average comes down and your payout just become bigger and bigger. And with the buybacks as well, I mean, you just get a bigger chunk of the pie. Now, I'll show you a couple of numbers here from the latest earnings report. So for the first 9 months results, so adjusted diluted earnings per share is up 3.3%. Cash return to shareholders, $5.7 billion, so $700 million of share repurchases and $5 billion in dividends. Now, of course, with the announced acquisition of Enjoy, what's the plan now? How are we going to move forward? So the initial progress here, they strengthened Enjoy's supply chain, improve inventory conditions in stores, and are actively working to close remaining inventory gaps. We talked about that actually in the last video. We covered Altria. Basically, even though it was in stores, it was really not presentable. It was really not showing that, oh, this is another option. They are changing that. And of course, Altria being a huge company, they have better supply chain access than just Enjoy. Then they grew distribution of Enjoy Ace to 42,000 stores. Ace is now distributed in all the top 25 convenience stores chains by e-vapor volume, and they began to amplify visibility with new point of sales and fixture signage. Then with regards to the oral tobacco category in the United States and on shipment volume, you can see a nice increase here for both. Then as for the margins, despite all the headwinds, it still improved a little bit. And then with regards to the financial outlook, so they are narrowing their full year 2023 guidance range, which was also one of the reasons why the stock was a bit red after they reported earnings. So they expect to deliver adjusted diluted earnings per share in the range of $4.91 to $4.98. This range represents a growth rate of 1.5 to 3%. From a base of $4.84 in 2022, which was basically why you see this huge red candle here. But as I said before, in the last couple of weeks, the stock has rebounded just like many others out there. That blue line here represents basically the bottom for back in July 2022 and September 2022. Remains to be seen what happens next. We are above the 20-day moving average here. RSI is still pretty low, but nothing to be so excited about right now. The 50-day moving average sits at around $41.65. The 200-day one sits at $43.80. Now, I do want to say that yes, there are some risks here. Risk of regulations, risk of new laws being put out that really Altria does not really have that much control over. So those are the things that you should keep an eye on, because yes, that will hurt the company financially. But other than that, right now, enjoy the fact that this is offering a 9.52 dividend yield. Buying back shares, the stock doesn't really move that much, so you can just buy back more and more shares, increase your position, which will increase your next payout. So overall, that will be it for this video. Those are the 3 companies. Of course, there are many other companies that you can add. We'll do many versions of these types of videos in the future. Do share your thoughts down in the comments below. What other companies do you own in your portfolio? What companies do you want me to cover in the next ones? Let me know down in the comments below. Happy Thanksgiving. Hit the like button, subscribe if you have not, and I'll see you all in the next one. Bye-bye.